Do you want to start investing but only have a small amount of money to invest? Do you want to turn that £100 in which you have to get started into a £10,000 investment portfolio without having to find the next Apple or Amazon and doing minimal amount of work along the way too? Well, in today's video, I wanted to share with you guys an investment strategy that actually beats 90% of stock market investors and provides returns that will certainly allow you to achieve this size of investment portfolio. But before we dive into it all, guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below. So I'll drop a like on the video, guys. Really helps out the channel. With that being said, let's dive straight into it. Now, investing into the stock market can be pretty overwhelming, especially if you're new to investing. You hear about all of these different terms like growth stocks, dividends, index funds, ETFs, call options, put options, and even cryptocurrency. Plus, to compound this problem, you probably didn't get taught about any of these investment terms at school, or indeed how to grow an investment portfolio. So today I'm going to do my very best to provide the financial education in which I know we all missed out on by sharing one very simple investment strategy. Now, I really want to emphasize the word simplicity here because there are a huge number of investors, 90% in fact, who really do overcomplicate things. There are certainly many investors out there trying to certainly find the next Tesla, which can provide thousands of % return on investment, and in essence looking to flip their £100 in which they have to invest into £10,000 overnight, or alternatively go for that big fat YOLO investment in AMC call options because you saw someone on Wall Street bets turn a very small investment into tens of thousands of pounds. The reality is it's very easy to get distracted and go from one stock to the next stock, from one strategy to the next strategy in order to chase the best returns on investment. But truth be told, there are approximately 630,000 publicly traded companies, which means that unless you've got a hell of a lot of time, effort, energy, and expertise to put into investing into the stock market, it's certainly going to take you an extremely long time to sift through all of these companies and actually find a good one that's worthwhile investing into. Now, don't get me wrong, guys, there's absolutely no harm in holding some speculative positions within your investment portfolio. I certainly hold some speculative positions, however, it's all about balance, and for the vast majority of people, it's certainly best just to leave the speculation alone and leave it to the professionals down on Wall Street and down in Canary Wharf. And as John Bogle, the founder of Vanguard, which is the largest mutual fund company on the planet today, once said, instead of trying to find a needle in a haystack, instead just buy the whole haystack. And that's a strategy in which I want to talk to you guys about today. It's a strategy called ETF Investing. Now, an ETF is short for exchange traded fund. Now, an exchange traded fund simply looks to mirror the overall performance of different stock market indices as well as different industries all around the world. But what makes ETF investing such a good investment strategy? Well, to kind of illustrate this and bring this to life for you guys, well, let's talk about doing the opposite and doing stock picking instead. Think about it like this. If you had your full investment portfolio, regardless of how big or small it was, you had all of your eggs in one basket and you were fully invested into one stock, and that stock is Tesla. Now, this example is completely hypothetical. It certainly doesn't illustrate my personal views on Tesla as a company and Tesla as an investment opportunity. But let's just say, for the purpose of example, in this hypothetical scenario, that Tesla over the course of the next few years or so didn't deliver as all of the investors certainly expect that they would do. Let's say they weren't successful in delivering fully autonomous vehicles. They all of a sudden stopped production or weren't able to expand production in line with the expectations that Elon Musk certainly has. Let's say they further delayed new vehicle models coming out into production, and on the whole, they weren't able to benefit from the economies of scale that mass production certainly gives you. And due to that, Tesla went back into unprofitable territory and weren't able to generate any kind of profit whatsoever. Now, these are potentially some of the real concerns for all of the Tesla investors out there. But let's say this actually became a reality for Tesla, and Tesla started to face fierce competition from the incumbent manufacturers, and as a result, Tesla's stock price started to really fall. Well, if you had all of your eggs in the Tesla basket and you were not diversified, if Tesla did not go on to be the successful entity in which it is today at some point in the future, and their stock price absolutely tanked, as a result of which your investment portfolio would absolutely take a beating as well. But this is where the benefits kind of come from ETF investing. You can invest into something called the Vanguard VUSA S&P 500 ETF, which simply tracks that of the overall S&P 500. Now, from investing into this kind of fund, you gain access to Tesla and exposure to Tesla, roughly about 1.5% of the overall ETF. But along with that, you also gain exposure to other great companies out there like Apple, Amazon, Microsoft, Alphabet, Alphabet, Berkshire Hathaway, JP Morgan, Johnson & Johnson, and roughly 500 other companies out there. Due to this, if Tesla or just one of these companies had a monumental up at some point in the future, the chances are your overall investment portfolio would still be very much in the green. The reason being that the S&P 500 is actually reviewed every quarter, and every single quarter those companies are refreshed. So the worst performing companies drop out the S&P 500 and the best up and coming companies actually enter into the S&P 500. So as a result of which, when you are investing into an S&P 500 ETF which tracks the S&P 500, in essence what you're getting hold of is the top 500 or 500-ish companies in the United States of America at any single point in time. So you certainly minimize the risk of being exposed to one single company and having all your eggs in one basket. Instead, you've diversified your investment portfolio, you've mitigated your company risk, your sector risk, and as a result of which you've got exposure to a wide range of stocks across a number of different sectors. But now let's take a look at the S&P 500 from a return on investment point of view, because the chances are that's what all of you guys are certainly looking for. Well, from my point of view, I feel like it's really a challenge right now to kind of steer people away from the high risk speculative plays based on the potential return on investment opportunities. And I really do want to reiterate the word potential here, because a lot of people are certainly getting carried away with the possibility, the potential, the hope of a solid and extremely outrageous return on investment from high risk speculative investments, making you turn your £100 investment into £10,000 plus pretty much overnight. Because the reality is, if you're investing into the long term, you simply don't need to put all of your savings and all of your money into AMC call options in an attempt to go from rags to riches. So instead, the average rate of return of the S&P 500 over the course of the past 20 years has been roughly 12.3%. But let me be clear here, just because the average rate of return is 12.3% per year, doesn't mean that you're going to get 12.3% per year consecutively, year in, year out. Some years your investment portfolio might be up 38.5% like it has been over the course of the past 12 months, but then other years the investment portfolio might be down, like we saw during the financial crisis of 2007 and 2008, and like we saw during March last year where the stock market tanked about 32%. I think very much the key to investing is to not be too excited by the potential high return on investments, but also not to be fearful of the corrections that will certainly loom too. Because on average, corrections happen every 1.87 years. So every couple of years you can expect your investment portfolio to fall in value by 10% or more. But don't let that discourage you, because over time, as the S&P 500 has certainly proven, especially now we're trading at all-time highs once again, that the S&P 500 has always come out on top. So to put this into perspective, to actually show what's possible here, let's say that you started out with a £100 investment and you invested that £100 every single month into the S&P 500. After 6 whole years, you would have achieved that £10,000 investment portfolio. Now, for some of you guys, that's probably not enough to get you out of bed in the morning, but when the power of compounding starts to take place, that's when you'll really start to see some real gains in your investment portfolio. So if you did this for 15 years, your investment portfolio would be valued at £52,000. After 30 years, it would be £377,000. And after 40 years, it would be £1.3 million. Now, you might be saying to me at this point, well, Mitch, after 40 years have gone by, that £1.3 million in 40 years from now certainly won't be worth the same £1.3 million in which it would feel like today. And you'd certainly be right, because we have to factor in something called inflation. Because as we know, currency devalues over time, and we've certainly seen that over the course of the past 12 months with both the US and the UK certainly being kept afloat by the government's bank book. But that's why it's so important to actually focus on investing into asset classes that actually outstrip the rate of inflation, which over here in the UK, the Bank of England have a target inflation rate of about 2% per year. Because if you think about it, guys, if you're able to pull, let's say 10% for your investment portfolio year in, year out, and you're able to grow your wealth by 10% per year, but inflation is only 2% per year, well, you're then technically becoming 8% on a net basis, 8% wealthier year in, year out. And that's certainly a great place to be in, because most people spend their lives with their money being eroded by inflation rather than investing it in order to beat inflation. So if you can invest your money and simply just beat that of inflation, then you're absolutely winning. Now, there are 3 ways in which I personally believe will help maximize the return on investment using the power of compounded growth. And these 3 principles are principles in which I've certainly looked to adopt within my own investment portfolio. The first principle is consistency. It's not always about being able able to lump sum a big amount of money into the stock market any single point in time, because I don't know about you guys, but I certainly don't have £100,000 in cash at my disposal to be able to lump into the stock market. So instead, I've had to slowly, consistently build my portfolio over time by investing into the stock market every single month. However, having this consistent approach over the course of the past 3.5 years or so has allowed me to build an investment portfolio valued at roughly £40,000. The second principle is scale. The more money in which you can invest into the stock market, the quicker in which your investment portfolio will grow. Now, it certainly sounds like I'm stating the obvious here, guys, but if you're able to invest £1,000 a month versus out of £100 a month, then it will rapidly speed up the rate in which your investment portfolio will grow using the power of compounded growth. Now, having said that, it's also really important to try and stretch yourself when you're investing into the stock market. Now, what I mean by that is try and look for ways in which you can actually increase the amount in which you can invest into the stock market every single month. Perhaps you could go for that promotion at work to get a little bit more of a pay rise in order to be able to invest more money into the stock market, or perhaps let's say you could set up a bit of a side hustle and an online business in order to be able to generate a higher level of income, which will therefore allow you to invest more money into the stock market. The third principle is time. The longer in which you can allow your money to work for you, and the longer in which you can allow for the power of compounding to take place, the more in which you will benefit from portfolio growth. Now, appreciate that not everybody wants to wait 40 years in order to be able to retire, because I certainly don't. So that's why it's so important to certainly be consistent, but also look to scale your investment portfolio as quickly as possible. And if you can do that successfully, that will dramatically increase the value of your investment portfolio and therefore dramatically reduce the amount of time in which you have left to retire. So in a nutshell, guys, as the best in the business, Warren Buffett advises, simply try and stay away from trying to beat the market, because 90% of investors fail to do so, and instead just simply invest into a low-cost ETF that looks to track the overall market average. You can use these ETFs in order to completely diversify your investment portfolio, take a completely passive approach to investing, and let the fund managers do all the work for you. If you can continue to invest for the next 10, 20, or 30 years, hopefully by that point you will have put yourself in a fantastic financial position and be able to retire early and do all the things in life in which you want to do. So if you took value from this video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.